This is wild. Trump just issued a 10-day deadline to Iran. Oil is up 12% over the last month, highest since August. First Majestic revenue is $464 million, silver production up 77%. China's silver backwardation is at a record high, shorts paying deferral fees to avoid delivery. Zero gold discoveries into consecutive years. Never happened before. Gold hit 5,000, silver 78. Silver Western spot is 78, futures 78. Shanghai spot 86, futures 88. An $8 premium. Trump has issued a warning regarding Iran's nuclear program, stating the U.S. must reach a meaningful deal and that the outcome will be known in about 10 days. He cautioned that if talks fail, the U.S. may have to take it a step further, warning Iran that bad things will happen as they cannot be allowed to possess a nuclear weapon, though he claimed the Middle East is currently at peace. Amid these escalating tensions, U.S. crude oil futures have extended gains to 12% over the past month, reaching their highest level since August 2025, as the U.S. has positioned nuclear-capable B-52 bombers at Al Udeid Air Base in Qatar, just 720 miles from Tehran, while prediction markets have spiked on reports of a possible strike, pushing exit odds to 54%. With additional forces and missile defenses deployed to the region, wars are inflationary. History proves this. When geopolitical risk shifts from abstract to imminent military action within a specific time frame, markets reprice everything connected to conflict, energy, strategic materials, safe haven assets all move simultaneously. The ones who read primary sources know conflicts don't just impact oil. They redirect capital flows toward hard assets and physical supply chains, while paper promises get questioned first. Majestic Silver has unveiled financials packed with records that scream opportunity, starting with record quarterly silver production of 4.2 million ounces, a 77% jump year over year, while revenue exploded to $463.9 million, a staggering 169% increase from the same quarter last year. With 60% of that coming from silver, cash flow from operations soared to $301 million. Net earnings flipped to $105.2 million from a loss in 2024, and free cash flow hit to $150.4 million, nearly quadrupling prior results. On an annual basis, silver production smashed records at 15.4 million ounces, an 84% leap, with total revenue for 2025 reaching $1.57 billion, up 124%, while the company's treasury swelled to a historic $937.7 million in cash, triple the prior year level. Starting in Q1 2026, dividends will double to 2% of net quarterly revenues, signaling confidence in ongoing strength, with costs controlled and silver demand heating up. First Majestic is primed to deliver outsized returns in a bullish metals market, but this isn't isolated company performance. This reflects what happens when the mining sector operates in an environment where metal prices finally reflect supply and demand fundamentals rather than decades of paper suppression. When producers post record profits, quadruple free cash flow, and triple treasury positions, it signals a structural shift, not a temporary spike. China's silver market remains physically tight despite a stabilization in international prices, with record backwardation and decade-low exchange inventories signaling a strong preference for immediate delivery. Investment bar demand and solar manufacturing procurement continue to drain stockpiles, while short sellers pay deferral fees to avoid delivery, reinforcing evidence of localized scarcity. The front-month silver contract on the Shanghai Futures Exchange has climbed to a record premium over the next active month, a structure known as backwardation, where prompt metal commands a higher price than future delivery. Such significant backwardation is driven by an inventory crisis and the depletion of deliverable material, and institutions still have incentives to continue squeezing the market for profit. Warehouse stocks linked to the Shanghai Futures Exchange and Shanghai Gold Exchange now sit at levels last observed more than a decade ago, and according to merchants in Shenzhen's primary bullion trading hub, whenever there are stocks, they are sold off quickly. The tightening visible inside China coincides with a broader restructuring of global silver sourcing, particularly across Latin America. Over the past several months, U.S. policy and private sector initiatives have increasingly redirected concentrate flows toward domestic refining capacity, reshaping traditional supply pathways that previously fed Asian processing centers. This development aligns with a modernized hemispheric resource doctrine, a renewed emphasis on securing critical mineral supply chains within the Western Hemisphere. Industry reporting indicates increased receipt of silver concentrate within the United States by major financial institutions and affiliated refiners. If Latin American concentrate that might otherwise have been refined for Asian delivery is increasingly routed through U.S. facilities, the available supply entering Chinese exchanges becomes structurally constrained. In such an environment, the backwardation in Shanghai reflects both local inventory depletion and the friction introduced by these altered trade routes. The recent surge in metal prices represents a wake-up call, not a market top. Mining is defined by long development timelines, rigid supply growth, and capital cycles that unfold over decades, not quarters. The forces behind today's repricing, prolonged underinvestment, constrained supply, and rising structural demand remain intact and unresolved. What we've seen to date is the awareness phase of a bull market where institutions caught off guard have rushed to deploy capital without sufficient industry knowledge, pushing prices higher across the sector. Have you ever wondered why gold is making headlines again? Let's break it down. Historically, gold prices have been a key indicator for the entire metals market. Think back to World War II. U.S. government debt was huge, but about 51% of it was backed by gold. Fast forward to today, our debt is even larger, yet only 3% is backed by gold. If we were to return to that 1940s level of backing, some analysts suggest gold could be valued at an astonishing $75,000 per ounce. What's more, for the first time in history, we've had zero major gold discoveries for 2 years straight. Meanwhile, central banks, especially in the East, are buying gold at a record pace. They're moving away from the dollar and re-embracing gold as a core reserve asset. With U.S. debt projected to double by 2036, even in a best-case scenario, the case for gold as a stable store of value is stronger than ever. Thanks for watching. Don't forget to like and subscribe for more insights. At the core of the mining industry lies the cycle in metal prices, and at the center of that cycle stands gold, which sets the tone for the broader metals complex. Bill Bonner wrote in Empire of Debt about how sovereign debt expansion eventually forces monetary debasement as governments choose inflation over default when debt service costs exceed revenue capacity. During the last period of extreme debt expansion, World War II, U.S. government debt surged to levels comparable to today. At that time, roughly 51% of federal debt was backed by gold reserves. Today, total debt is even larger, yet only about 3% is backed by gold. This comparison powerfully illustrates just how deeply undervalued gold is on a historical basis. Without speculating, consider the math. If U.S. government debt were ever backed by gold at the same 51% level seen in the 1940s, total U.S. gold reserves would need to be worth roughly $20 trillion, with 261.5 million ounces of gold. That implies a gold price near $75,000 per ounce for the first time in recorded history. Global data shows zero gold discoveries into consecutive years. This has never occurred before, and this is not unique to gold. Major discoveries across most metals have fallen into single digits, with no meaningful projects in the pipeline capable of materially altering the global supply curve. Mining is 4% of global assets versus a 24% historical average from 1921 to 1981. Silver mining equities are trading at historic valuation lows relative to the metal itself. Most primary silver producers continue operating with all-in sustaining costs well below $20 per ounce, yet current equity valuations only make sense if silver prices fall back toward those levels. Central banks are turning to gold. The global financial crisis showed world risks of dependence on the U.S. financial system. As a result, central banks broke a 2-decade trend of net gold sales and began buying gold at a record pace. Led primarily by non-Western central banks, the seizure of Russian assets and exclusion from the SWIFT system led to a roughly 2 times increase in gold buying. As the risk of holding U.S. treasuries increased significantly, we are witnessing the remonetization of gold and the bifurcation of the world. As the West keeps betting on the old dollar-centric system, and the East is moving to a gold-centric system where gold is once again becoming the preferred reserve asset. According to analysis, even in a perfect world with no recession for 10 years, U.S. debt is projected to hit $64 trillion by 2036. That's 2 times 2023 levels, 3 times 2018 levels, and that's an optimistic scenario without any crisis catalyst. The S&P is showing an unusual pattern. 54% of stocks currently overbought, the highest percentage since June 2025, while simultaneously 26.8% of names are oversold, the highest since October. Last Friday marked only the 13th day since 2007, where both the proportion of overbought and oversold stocks rose by more than 10 percentage points over a single month. Under usual market conditions, these metrics move in opposite directions. This means a significant number of stocks are seeing aggressive buying and selling simultaneously, representing a rare shift in price action that typically precedes major directional moves. Now, someone asked me the other day how banks manage to push silver prices lower, so I explained the mechanics. They flood the screen with giant fake sell orders, millions of ounces, making it look like huge supply is about to hit the market. Bots and scared traders see that wall of red and panic sell, instantly crashing prices 3 to 8% in minutes. Then they cancel 99% of those orders in milliseconds they were never meant to be filled, and quietly buy back the cheap silver they just created. They repeat this every option's expiry and every time price threatens psychological levels. This isn't theory, it's a documented manipulation playbook used repeatedly. A bearish case requires examination. The Iran deadline could result in a deal removing the immediate conflict premium. Trump has a history of talking a big game until markets believe him, then beating a hasty retreat. Mining equity undervaluation could persist if institutional capital remains focused on tech and AI. China's backwardation could resolve through a seasonal production increase. The hemispheric silver realignment is still developing, not fully implemented. First Majestic's results could be an outlier, not a sector-wide trend. Thursday's price pattern break could be a false signal. U.S. debt projections assume a baseline with no catalyst to trigger a crisis. This is financial warfare education, not investment advice. Looking at the data objectively, the Iran deadline is now just 10 days away. With nuclear-capable bombers already positioned in Qatar, and oil is already up 12% in a month. First Majestic is demonstrating what happens when miners operate at real prices rather than suppressed levels. In China, buyers are paying deferral fees to avoid delivery in mid-decade-low stocks and record backwardation, while hemispheric concentrate flows are redirecting from Latin America to the U.S. instead of Asia, creating structural supply constraints for 2 consecutive years. There have been zero gold discoveries, unprecedented in recorded history. The mining sector sits at just 4% of global assets versus a 24% norm, requiring a 6 times move just to revert to the mean. Central banks are buying gold at a record pace, breaking a 2-decade trend of net sales, while U.S. debt trajectories point to $64 trillion without a recession, and the S&P is flashing a rare dual overbought-oversold signal that historically precedes major moves. What warrants attention now? A geopolitical catalyst is moving from abstract to imminent with a specific timeline. Mining profitability is responding when prices reflect fundamentals. Physical silver markets in the East show extreme tightness, while the West restructures supply chains. The discovery pipeline is empty across metals. Institutional positioning remains historically underweight, while fundamentals appear historically bullish, and the monetary system shows signs of bifurcating between a dollar-centric West and a gold-centric East.